Andreas Clenow is the Chief Investment Officer for ACIES Asset Management, a Zurich-based asset management firm with a 9-figure asset base. Starting out as a successful IT entrepreneur in the 90s, he enjoyed a stellar career as global head of equity and commodity, leaving for the hedge world. Having founded and managed multiple hedge funds, Mr. Clenow is now overseeing asset management and trading across all asset classes. He is the author of the best-selling and critically acclaimed book, Following the Trend, as well as recently released Stocks on the Move. You can reach him via his popular website, followingthetrend.com.
Thank you for that, Paige. And thank you to everybody for listening. Now, my talk today, and I'm going to take about a little bit more than half an hour of your time. I'm going to talk about specific algo opportunities with futures. And my main assumption here today is that you guys listening are probably quite familiar with stocks, with more traditional type of financial instruments, with cash-based instruments, and I'm going to talk a little bit about what is unique with futures, how can this open opportunities to build different type of quant models, what kind of new data is available, and what kind of data can we create that we simply cannot create in cash equity world. And I'm going to break a habit with my QuantCon type presentations, and I'm actually going to show you math this time. It's going to be quite a simple math, simple formula, but for once I'm actually going to show some mathematical formulas in a quant presentation. Now, first of all, here's my outline for this talk. First, I'm going to explain some basics about futures, because it's important that everybody who listens to this understands the basics of what we're talking about, how futures work as instruments, how they differ from equities and from cash instruments in general, the kind of properties that make futures very valuable to quant traders, and especially, of course, why futures has been the instrument of choice for the trend following space in particular, but increasingly for all types of strategies. I'm going to touch a little bit upon the issues with futures. One thing that usually creates mistakes or confusion early on when people start with this is the implications of having many possible available simultaneously traded instruments at any given time. There is many different deliverables of the same asset at any given time. From there, I will move on to discuss what you came here to listen to, which is what kind of opportunities this opens up, how we can find some new interesting type of data, how we can use this to create uncorrelated investment strategies. So first, about futures, what you need to understand about futures and the major difference compared to any other type of cash instruments that you might be used to, if it's stocks or even currencies or bonds. The futures market is very much a zero-sum game. You can say that about all derivatives markets really, but it really stands out with futures. I think it was an great American thinker who once summarized this way of working best. He said that it's a zero-sum game, and money itself is not gained or lost, simply transferred from one perception to another. The great Gordon Gekko, of course, in 1986. With futures, if you are gaining, somebody else is losing. And this is very palpable because this is on a day-to-day basis. See, if you buy a futures contract, that means that somebody else is necessarily short. For every single futures contract that exists, somebody is long and somebody is short. At the end of every single day, not even at the expiry of the contract, but at the end of every single trading day, there is a settlement price for the futures contract, and money flows from the person who gained that day to the person who lost that day. So at every single day, there is a winner and there is a loser, and there is no net new money in the system. You could even argue there is a negative sum game, since we have commission trading costs, of course, involved, but for all intents and purposes, you can see it as a zero-sum game. You can only win on somebody else's expense. And of course, I'm going to make the reasonable assumption that anybody listening to this is probably either already working in finance or wants to work in finance. So you probably don't have any larger moral issue with gaining on somebody else's expense. Now, as far as derivatives go, futures are very simple. They're very easy to understand. They are very easy to calculate the return, the logic of who gains, who loses, how much. That is not always the case. If you look at options, for instance, I am not a big fan of options. Not that there's anything necessarily wrong with it. I just don't really like trading options. With options, you have very complex mathematics behind it. You don't have that with futures. Very easy to get started with, very easy to understand. My own philosophy about trading options can be summarized, as you see here on the slide in front of you, with the old proverb, "Timeo danos dona ferentes," which roughly translates to "I fear the Greeks, even those bringing gifts." Now, futures are exchange traded and cleared. That is a very important point. You don't actually trade directly against the other person. If you go long, somebody else goes short, but you don't have to know or care about that at all. It's all handled through the clearinghouse. It's all anonymous. So the upside here is you won't actually see the person you are hopefully taking money from. There are two types of futures. You have financial futures and you have physical futures. Now, the financial futures are settled in cash, only cash. This is the standard ones like the S&P 500 contract, for instance. At the end of the contract, right? It was at the end of every day, but as well at the end of every contract, at the end of the day, you transfer the so-called mark-to-market, the change. But the only thing changing hands here is cash. For physical futures, at the end, there is theoretically, in a way, something physical changing hands. And you might have heard about the various anecdotes or stories about somebody who forgot to close down their long live cattle position or lean hog position and ending up with a truckload of cows or pigs outside the office. That's not actually going to happen in real life, even if it is a vaguely remote theoretical possibility. Futures do work like that, in theory, the physical ones. There is actually an obligation to make or take delivery, but very, very few contracts. I don't know the statistics, but I'm going to go ahead and make up a number anyway and say that about 5% of all futures contracts go to delivery. And the rest of them are closed before, which means if I buy a contract of live cattle today and I sell a contract tomorrow, I'm net flat. I have nothing open. Therefore, no delivery is made or taken. Your broker will not actually allow you to keep the physical contracts open past the critical date. So it's not really a real world possibility that you might forget and stumble upon delivery, except of course in the currency market. So careful on those ones. Futures are standardized, and I would say that is the main thing about futures that makes them so attractive. The standardization of futures means that you don't have to care really about the underlying details. You don't need to know anything about how to trade a live cattle, to use the same example, or to know anything about the metal palladium to trade that contract. It's all standard deals. You don't need to understand exactly how it's going to be delivered, where and how, the quality, all of these things is all standard. That means that in the end, it boils down to a few simple parameters you need to know about every futures contract, and then you can trade all of them the same way. And this as well comes back to why futures are so popular among quantitative traders, and particularly in the trend following space, which is my own background as well, because you can trade everything the same way. We can trade equity indices, the S&P 500 or the German DAX, the same way that we trade palladium or the Swiss franc or bond markets. We can trade it all with the same type of logic, the same type of mathematics. We might need to adapt our trading rules, possibly. Maybe we can use the same, maybe not. That's a whole different story, but the mathematics is the same. You can't say that about, say, the swap market or something more exotic. This might seem like a given point now, but it's because, well, we have been around with futures for too long, but we're used to this nice feature of them. This was not at all a given when this whole futures business started, but it is probably the large part of information to the futures market success. So if you know a couple of standard points about your futures contract, then you can put it into your system and you can trade it like anything else. Now, the most important things to understand is on a per market level, that is, one market could be gold or palladium or soybeans, S&P 500. Per market, you need to first understand the multiplier. That is, if you hold one contract of gold, for instance, and gold price changes $1 full, how many dollars change is your profit or loss, your P&L? That is your multiplier. That's the easiest way to look at multiplier from a point value from a trading point of view. What it actually means is how many units of something are you trading. Is for the big gold contract, for instance, if you're trading 100 ounces of gold for every contract, that's what the contract represents. But as a quant trader, we don't really understand. We don't really need to understand the unit itself. It doesn't really help. The natural gas, for instance, is traded in British thermal units, and you take it from me, you can trade that market and do quite well without having any understanding at all about what a British thermal unit is. With the currency, one thing to mention there is, unfortunately worded perhaps, be careful with minors, which is when you're building your trading models, just make sure that you understand first which currency it is, of course, which major, if it's a dollar or sterling or whatever it is. But also, some markets, it's unusual, but some markets are traded in minor currency units, as in US cents, for instance. And yeah, take care for that, take care about that, otherwise that can seriously mess with your trade sizes. On a contract level, the ticker here should probably be on the markets I see as well here, sorry for that on the slide. On the contract level, you need to look at the delivery amount, of course, the expiry date, and for physical futures, notice date. That is, futures have a limited lifespan, and that is the main point that I am about to make here. And for every contract, there's an end date. That's the expiry date. For most contracts, for financial futures, you can generally hold your contract until the expiry date. For physical futures, if you hold after the first notice date, which again, your broker will probably not allow you to do anyway, but in theory, if you hold it off the first notice day, you can be asked to, or you can be required to make or take delivery. So this is when you need to be out. And even if your position will be closed automatically, if you forget it, it's not something that you really want to have happen. When you trade futures, again, major difference from cash markets. When you trade futures, you don't need much cash. What that means is, well, for futures, we don't need to pay up front. When you buy shares of IBM, you generally pay that up front in cash. Sure, you can get a little bit leverage. You can have a slight margin on stocks, but it's expensive and you can't really have much margin anyway. Very different with futures. When you open a futures position, you only need to put up the initial margin for the futures contract, which is different for every market, of course. If you add up all your initial margin requirements, all the initial margin for the positions you have open, and you divide that by your total portfolio value, you get your so-called ME ratio, margin to equity ratio. And as it says here on the slide, most professionals trade between 10 and 20% margin to equity range. The implication of this is that we have a very large amount of cash laying around. 80%, 80 to 90% of the cash is in theory not needed. So if you do nothing, that's going to be laying around in cash on your bank account, your broker account, which is something that you probably don't want to do. If you were a customer of Lehman or MF Global, you know what I'm talking about. If and when something bad happens, your broker blows up unexpectedly, your cash is gone. Your securities can generally be recovered unless you're dealing with outright fraud, but generally your securities can be recovered, but not your cash. That will be gone. Anything that is not covered by government guarantee, if you have those. So you need to have cash management, of course. Since you don't need much of your capital, the rest you need to put somewhere safe. Usually in the business, we will put it in shorter dated government securities, or government papers rather, money market instruments and so on. This used to, in the old days, generate very handsome return. It used to be that we got very nice free income on this, on placing the money to be safe with the government, because interest rate used to be much higher. Those were fun days, by the way, because, well, we still got paid performance fee, of course, based on return given on risk-free investments with the government. Those were fun days. But those days are unfortunately gone. These days, you just have to do it for safekeeping. Now, the fact that we don't need much capital, that we can use only 10% or 10 to 20% of our capital and get what most people would say is normal, sane, prudent exposure. It means that we could also, in theory, use this to gear up, leverage up if you're American, to put on very, very large positions. We could take on enormous positions in the futures world if we really want to. That is not a good idea. If you plan to use futures just to increase your risk and just to try to run some get-rich-quick scheme and gamble, that is a very bad idea, and I would strongly discourage you from it. You probably find much better odds at the local casino. But the fact that we don't have to care about notional exposure is a great thing in the future space. See, in equity space, we have to care about our actual notional exposure. That is, how many percent exposed are we to stocks? Because once we hit 100, we run out of cash. When we run out of cash, it's very expensive to leverage up and to essentially borrow money to buy more. So we're always limited by that. In the future space, we can look purely at risk measurements. So we don't have to care about how many percent we are exposed to a certain market, what is a notional value compared to the portfolio value. It's irrelevant. What we can do is we can come up with a risk target and just don't care where the exposure ends up. It's not a limitation in the futures world, which is a very nice feature. Now, getting to the more real things. What you're looking at here is a so-called futures chain from one of the two major market data system providers. A futures chain shows you all the currently traded deliverable contracts. It is all the individual contracts for a specific market. In this case, as you see, GC at the top, GC being the big gold contract, the COMEX gold. And here, as you see, we have quite a few different contracts traded at the moment. You could take a trade in any one of them. It might not be a good idea, but you could. First thing to notice here is just how many of them are traded at the same time. You see in the first column, MTH, month, March 8, April 8, May 8. These are not days, these are years, of course. And it's March 2018, the first one, and so on. There's the delivery month. Which month is it expiring? Next column shows last, is the last traded price. And here you should notice just how different they are. See, there's a good reason. I will get to some of those reasons why it's not the same. If you say that you're trading gold, well, you're probably trading futures, and that's not the same depending on if you're trading March 8 here or February 9. We'll get to that because that is part of the main topic here I'm getting to. Jump over to the other side here, and I believe I can somehow find a pointer. Here we go. So this column here, historical volume. This is yesterday's total volume. You see here how many are traded, how many contracts are traded, how many contracts changed hand that day. There's an indication of liquidity, of course, and you see that almost all liquidity is in 1 month. The second one here, the April 8th at this time. Open interest is arguably even more interesting. Open interest tells you how many open contracts do we have at the moment. Now, this is a minor one, but it's still a time series that is new if you come from an equity or cash background. If I buy a contract of gold right now, I will increase the open interest by 1. So I click buy, I go long the contract, somebody else goes short, and the open interest increases by 1. If I wait an hour and I close it again, I sell the contract, the open interest will then be reduced by 1. So here we see again that almost all the liquidity is in 1 month, in the April 2018 at the time this screenshot was taken. This will almost always be the case. One contract has the overwhelming amount of liquidity, and that is the contract you almost always want to trade. I will get to a bit later how you might at some point want to trade something else, but almost all the time you want to trade the liquid one. This is coffee, 6 different contracts of coffee traded at the same time, showing the price development over time. Now the point here is to make is just that they are different. They're not the same. Sometimes they are closer together, sometimes they are further apart, but they move differently. You could say that these are details, but in the quant trading world, we like data, right? And we like these small details that we can possibly exploit somehow. So that is what we are getting to. Liquidity tends to move from one contract to another like this. Here you see wave after wave. This is a very old screenshot, I see, but you see in the sugar market here how the contract open interest keeps increasing in one contract until it takes over. That contract is the highest for a while, they're the most liquid, until the next contract slowly creeps up and takes over as the most liquid one. So at any given point in time, you will easily find which contract is the most liquid one. And the open interest is, of course, a great indicator of that. Implications of this is, first, since contracts have limited lifespan, we don't have long-term time series. They just don't exist. We can try to build something, we can try to estimate something, approximate the experience of having a position for a long time, but as opposed to, say, an index or a stock or something, we just don't have proper long-term time series available. So we then need to, when we trade, we need to select which contract to trade, and we need to decide when and how to roll it. And that's a very important part of futures trading. The long-term development of the price is very often quite different from the underlying. And that is a really important point that far too many people are missing. And I believe I have a good slide on that coming up quite soon. Sometimes the underlying has very little resemblance even to the futures development. But first, the issue I mentioned here with the non-existence of long-term time series. What you're looking at the moment here is a so-called default continuation. This is again from one of the two largest and most expensive market data providers out there. And you might think that if you pay a couple of thousand a month for data, you should get everything nice and right and just ready to use. Don't make such assumptions. See, what you're looking at here is a continuation made by simply putting one contract after another. When one expires, the next one takes over with no adjustment. As you saw before, the contracts have different prices. They differ a little bit. So if they're not the same at the time of rollover, a chart like this will create an artificial gap. Look at this. Here's the same continuation at the background, but each box here, each color represents one contract. The box shows when that contract, that color is the one used for the continuation. And the worst example here is, of course, the really big one in the middle, the one circled here, where the continuation dropped down a lot, the black line here. But this didn't happen in the market, because in reality, you would be long the blue contract here, up here, if you see my marker, you would sell this, and then you would buy the next one, the green one down here. And the continuation shows an artificial gap, a straight move down, which just didn't happen in the market. That means be very careful with continuation. If you use long-term charts or time series rather, find out exactly how they are made and make sure they are done correctly. Otherwise, they are quite useless. The underlying of futures contract, that is the actual market behind, is rarely tradable. There is also an interesting point to understand in case you haven't thought about it before, that the S&P 500 index, for instance, is not tradable. You cannot buy the S&P 500 index. It's just an index. You might say that, sure, you can buy the S&P, right? You could just buy the SPDR, the SPY ETF. But that's not the index, is it? That is a very well-constructed ETF, which replicates the index and has a very small tracking error. But it's not the index. It's a product that is designed to replicate the index as close as possible. The index is not tradable. With few exceptions, the underlying of the futures you're trading are not directly tradable. So what that means is that the products that you are trading are behaving differently. And if you're not trading the actual spot, then analyzing it maybe doesn't make much sense. It can trick you into getting false impression of the price moves. For some markets like the S&P 500, for instance, it is not a very large difference. The S&P 500 moves in quite similar fashion to the S&P 500 tracker, the SPDR, or even the futures move quite similar to the market. But that's not the case for many futures contracts. Many markets move very, very differently. So the point here is that make sure you analyze what you trade and trade what you analyze. And here is one example, admittedly the most extreme example I could think of. This is the VIX index, starting in 2004, going into 2018. Looking at this, it looks like the index went more or less sideways, and it looks like if you bought in 2004 and you just held on to it and you just dealt with this moves up and down over the time. It's quite large moves, but if you just hang on the whole time, you should have more or less the same money as when you started. But the VIX index again is not tradable. So if you would have actually traded this, if you would have bought the VIX index futures, the VX future, and kept rolling it, as the volume, as the liquidity and the volume moves from one month to another, you roll to the next contract and the next, and you keep your long position open, you would have experienced something like this, the black line here. This is just one way of estimating or trying to replicate the experience of a futures trader who held the position the whole time by adjusting for this difference in the contracts. You would have lost almost all your money holding this while the index went sideways. That is because the market was in a strong contango most of this time. Contango is something I'm just about to explain, of course. Contango has to do with term structure. Term structure refers to the shape of the relationship of the traded futures contracts for a specific market. In the first graph here, you see Arabica coffee, where the closest contract, the one that is about to expire when this chart was made, is at about 119. Each contract here is a little bit higher, a little bit more expensive. And that that can depend on many things. I'm not going to the fundamental side of the reasons, but briefly, it can depend on, of course, interest rates, but also things like storage, can be seasonality, but also storage and delivery cost. Look at it this way: if you were to hedge a position of, say, December coffee in the market today, instead of taking the future, so if you want to take the opposite side of the trade, if you want to hedge it, and remember in the financial world, if you can hedge something, you can price it. That is an important principle in finance. So we want to hedge it. What we can do is we can go and buy the actual coffee in the market, coffee beans, spot, deliver now. For that, we need to borrow the money, or we need to finance it. So we need to have the money and lock up the money that has interest rate implications. And then we need to store it. Can you store coffee for half a year plus? I don't know. I haven't tried it. You need to store it, you need to deliver it at the right time, in the right place, and so on, and that warrants a premium, right? And by that, you could explain, if you like, why the prices are higher. But in the end, we don't really care about reasons here. We're not into philosophy. We are just trying to trade. We're not looking for truth here. What matters is that contango, as you see in the first graph, has a bearish implication over time. Because imagine now that the coffee price is, the actual coffee price, spot, so to speak, is around 119. Now, the first contract is about to expire, so it's fine. It's probably about that. Second contract, if the actual spot price of coffee does not move at all, if it stays exactly at 119, then the next point will, by mathematical certainty, need to slowly move down until it hits 119 as well. That goes for all the other points. If the actual coffee price stays exactly still, all of these points need to slowly come down and meet the spot price, because the spot price is where it will be settled in the end. That means that you have a bearish bias from contango, from this pattern. Doesn't mean that the price of the futures has to go down. It means that one market force that acts upon this is the term structure, and since the term structure is in contango, it is a bearish force. You have the opposite situation in lumber. Lumber here is in backwardation. Who came up with silly names of contango and backwardation? I have no idea, but that's what the industry is using. Same thing here. If nothing happens, if the price of your planks here is going to build your fence, whatever you're going to do with them, if it stays the same at about 515 or so here, if it just stays there month after month, well, this contract here, further out the curve, will have to move slowly up until it hits that same point. So backwardation is then a bullish force on the futures price. I haven't mentioned, of course, yet how strong that bullish force is. Sometimes it matters and sometimes not. We'll get to that. And this is how it will look over time. This is a common type of chart. I think I stole the idea and replicated somewhere. I saw that. It's a neat way of illustrating it. If we assume that the asset, whatever that is, one in the middle here, moves up and down, and moves like that, a futures contract in contango would be like the top one. It starts much higher and slowly approaches. It moves more or less the same, but slowly approaches the underlying until it hits it in the end. By expiry time, it should be the same. And backwardation, the opposite. It will slowly get closer and closer and closer until by the end it hits the same point. That's an important part to understand about futures. The term structure quite often matters. Sometimes it is the most important factor acting upon a market. To understand how strong this force is, we need to quantify it. Looking at a graph, textbook style, and determining that the market is in contango and therefore we should go short, that's not a good idea. We need a way to do this mathematically. This is a quant talk after all. My preferred way of doing this is to calculate so-called annualized implied yield. Because we cannot use the dollar value difference between two contracts. It doesn't matter. It doesn't have any context to it. We need to have something we can compare, not just inside one market, but across other markets. Implied yield. With implied yield, we're looking at how big is the difference between 2 points in the curve, or rather 1 point and the spot, most common way of doing it. What is that in percent? How many percent more or less is one delivery compared to the spot? How many days left to expiry? Are we in a premium or a discount? That is a contango or backwardation. And then we annualize the number. What would that be on a yearly basis? And now we have a solid number we can compare, and now we're getting to actually creating some valuable financial data. Here's an example. I'll show you next. Next slide is the formula to do it. It's a simple formula, trust me. What we're doing here is visually on one side here and the table on the other. For every point, we can calculate the implied yield. That means the way to interpret this number is if the spot stays the same, does nothing, at what speed will this point move down to the spot? That is, on a yearly basis, how many percent does that equate to? So we need to know the price for the spot, price of the futures, and the days left to expiry, to annualize it. Easy stuff. This data is all available for free. The formula, again, I told you I'm going to show math, and I hate to disappoint you, but the math is very, very simple. If you have a basic finance degree or any sort of mathematical related degree, this is easy stuff. What I do here is just take the difference in percent and annualize it, in this case, to 360 days. Now, why 360? Why not say 65? Well, if you think that actual day count is superior to money market day count here, then feel free to use it. I don't think it's going to make any difference whatsoever. What we're doing is just trying to get a number that we can relate to. Just something that can be compared, since we are dealing with different time period. In this graph here, we see 67 days at one point, 127 in one on the other point. So we need to standardize it based on the duration of the contract. Easy stuff, but now we have a number that we can compare. Now we can actually estimate how strong is this bullish or bias, bullish or bearish force on the market. Is it worth bothering with, or is it important or not? We can use it for other things as well, but that's the first thing to look at. We can use it as a directional indicator, of course. If we figure out how large this is, then we can quickly see that some markets, it pretty much never is of interest. Like again, the S&P 500 or any equity index really is not an important enough factor to bother with. But don't take my word for it. Do the math on it. It's easy. For other markets, it varies. For other markets, you'll find that sometimes it really doesn't matter much, and sometimes the term structure is the only thing that matters. A classic example is natural gas situation up until a few years ago, when you had a consistent, steep contango, month after month, year after year, while the actual price of physical net gas didn't move much, natural gas that is, didn't move much. Trend followers were making a killing just being short and rolling short positions again and again and staying short for year after year. That was a major trade for trend followers for years because of the term structure. But again, these numbers If you do the implied yield math, you can find where it matters and where it does not. You could also use it sometimes to select contract. I said before that you should almost always trade the most liquid contract, but there are exceptions. These exceptions are only available if you're a reasonably small player. That is, if you're lucky enough to manage less than, say, $100 million, you are considered a pretty small player and you can use some of these tricks. This mostly gets important when you have a sudden change in the term structure, a steepening, for instance. And most of the time, it is in commodity space that you will find these opportunities. Here's an example. In this market, in this term structure chart you see here, you see that the first contract, the May contract, May 2018 here, has clearly the highest open interest. This is the bar in the background here, shows the open interest and thereby indicates liquidity. This is the one we will normally trade, but let's say we are now looking to take on a medium-term short position. Well, let's crunch the numbers here, and we see in the table next to that the implied annualized yield on the first point, on the May point, is negative yield of 4%. Now the second point has a negative implied yield of almost 15%. If we are now looking to take a trade over a couple of days, this probably doesn't matter at all. Doing an intraday trade, well, don't even bother. But if you're taking a longer term trade here, this could be something very interesting if the liquidity is enough. So you have to carefully look at liquidity and put it in relation to your trade size. How large are you trading? That's why I'm saying it's only available if you're reasonably small. If you have a large market footprint, you have to be very careful and be much more careful with liquidity. In this case, depending on your size, it might be worth taking the position in the July contract instead of the May contract, because we have this, well, you can call it tailwind. We have help from the term structure at this point. Of course, this data, I just showed you how to calculate a single point in time for this data, but there's nothing stopping you from creating entire time series out of this. And those time series can, of course, be analyzed for patterns, for relative movements in the term structure over time in different markets or in the same markets across different deliveries to find opportunities. There are many opportunities in trading and analyzing these time series. It's something I think many people are neglecting, many people outside the industry absolutely are neglecting. And this, of course, leads to the inevitable conclusion of spreads. With futures, we can very easily trade spreads. Because again, if we want to, we can take on very high exposure. As long as we keep the risk under control, exposure doesn't matter. And for spreads, quite often we need to take on very large notional exposure to get any sort of real movement out of it. Because with spreads, we are usually hedging out the main directional move. Take something simple as doing a calendar spread, for instance. You go long and short in the same market. So you take gold, for instance. You go long one delivery, you go short another delivery. Now you actually hedged out the directional impact of gold itself, and you just trade in the difference in the term structure, the shape of the term structure. That is a major value in trading and analyzing the term structures. Here, for instance, this is same as I just mentioned, but here is with crude oil. Now, when you trade these kind of things, you can find uncorrelated results. That is, if you build a trading model that trades just directional trading in crude oil, you will be ultimately very dependent on the direction of crude oil itself, whether it trends, how it behaves, and so on. But if you trade the spread itself, well, now you're not really depending on the direction, and you can find uncorrelated results, which is something that the industry, and I know especially the Quantopian hosting this, are always very interested in. being different and being uncorrelated. You could also do more complex spreads, of course, and here term structure is arguably even more important to analyze and understand. What you're looking at the moment here is a so-called crack spread, a 3-2-1 crack spread to be precise. A crack spread is a way of quantifying the profitability of refinery operations. In this case, we are short 3 barrels of crude oil. We are long 2 barrels of heating oil, and we are long 1 barrel of gasoline, which approximates the output of certain types of oil refineries. If this ratio that comes out is high, then it's very profitable to do refinery operations. So here, based on term structure, and quite often you see that these three markets have very different behavior in term structure. Based on this, you can find opportunities to trade spreads like this, which has real-world implications and real-world meaning behind them that were very well followed and researched. And again, find uncorrelated opportunities. Now, the last part is I just want to give you some things to think about, and please don't take these questions and copy paste and send to me, because, well, they're made for you guys to do some thinking and come up with your own ideas. These are just things that I would recommend that you look closer at, things that you could research further by yourself to further enhance your understanding of term structure, implications in futures, and how it can be used. So thank you very much for listening. Well, if you have your first two things. One is if you're an ETF, you have very specific predefined rules. Those rules are publicly available. You can download the rules for most ETFs. You can read them, which I recommend, by the way, because most ETFs do something very, very different from what you would think based on the name. Most ETFs are just structured products masquerading as consumer-friendly investment vehicles. So yeah, do read the actual rules. They are available. Also, if they are large enough, the rules doesn't matter. They have no choice. If you're moving massive positions, there's 1 or 2 days maximum where you can move massive positions in and out and not have a giant footprint, because that's when you have to get out. So there's very little choice in the end. That's just how the futures markets work in the end. That's where the liquidity exists. I mean, these ETFs are funny. The inverse futures of any sort, be very careful with, because they are not actually inverse from the underlying. Again, you have to think about how to hedge a product and how it's constructed. The inverse futures actually have, what they promise you is an inverse price move on 1 day basis. That implies daily rebalancing. If you do the math on this, you realize that these things are actually option products. They are not directional products on the underlying. The daily rebalance means that you're essentially short gamma in a highly volatile underlying, and you're thinking you have some sort of long-term negative delta exposure, and that's just not the case. All you need to do is punch up a long-term chart of any inverse ETF, especially the leveraged ones. They're really funny, and compare them to the price moves of the underlying. These are structured products. These are very dangerous structured products, and they're option products sold to people who don't know what gamma is, and that's a problem. But that's how the industry works, unfortunately.